Stocks finished a pretty quiet week, but if you look underneath the surface, it was probably more of a bullish week than we think it was. So I'm going to break down the how the market performed, what was kind of driving this move this week, and whether or not there's any red flags that this highly anticipated intermediate pullback will occur. So we're going to kind of break that down a little bit. We're also going to take a look at again, which sectors are poised to do pretty well in this environment. And then that's where our trade idea comes from. So we're going to take a look at a trade in one of the few areas where there is a decent reward risk ratio for directional opportunity in a very specific area of the market. So let's go ahead and get started. Today is Friday, August the 14th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicators. We always did me get rid of this drawing here from our class this morning. You notice we are just starting to just continue to grind. In fact, we still haven't got the new high tag over here on the cash index, at least. Market sentiment has turned back up. It's rising again. It's up at 75. The posture is strongly bullish. Near-term lines dropped down. It hasn't dropped below 50 yet, so we've got how many days, multiple days here of it being above 50. So this would be the first day in 1, 2, 3, 4, 5, 7, 8, 9, 10, 11, 12, 13. The typical run 7 to 12. We never did really drop right there. So we're still kind of in the midst, these with the potential of a near-term pullback here. So we're going to keep our eyes on that and see, especially with the cluster coming. And it's different when you get a cluster that's, nearly 4 months into an intermediate run versus when you very first get up above, like right there. It went sideways for a little bit after that, but you can see the nice rally we've had since. So strong posture across the board as usual. You can see the Dows, but the Dow and the Russell have really been unable to get going after this little breakout early this week of the 78% line. So at least it's holding the 78% line. The near term, the Russell actually has got the near term line below 50. So it kind of gives us an idea of what might be happening on the S&P. But you also notice too that the Russell is, that's it. Like that's not very much of a near term pullback, and it can bounce from here, right? It can get going to the upside. So it's not, that this. And the Nasdaq did get its near-term pullback at that point where the S&P only got to 50. The Dow has not. It's been kind of the one that's been hanging on the longest. So we've all kind of had, all these indexes have kind of had some type of near-term pullback, even if not necessarily official. Of course, the biggest concern is getting the momentum line down below 5, and then the near-term line well into the reversal zone. And we don't have that yet, and that's a good sign. And that's, as long as we don't have that, then these little pullbacks that we get, like we did on the Nasdaq, can just be viewed as buying opportunities with oversold momentum line and near-term lines that fall below 50. They bounce, and we bounce along with it. So, and we continue just to grind higher, and we go up and down a little bit here and there, but nothing significant. We talked about in our technical analysis class today, it's posted on our calendar at Market Scholars. We talked about, okay, what are we going to need to see for the intermediate line to get below 50? It just doesn't happen on a whim, right? We can continue to grind for months, as we've seen before. We've had a 5-month intermediate rally before we finally got a catalyst back in early 2018 to spark a little bit of a sell-off. Well, right now we are absent a catalyst, and so and we walk through kind of the idea behind that in class today. We also talked about from a technical standpoint, what do we need to see to show that on one hand we might just be dipping a little bit near-term line decline and that's it, or is that near-term decline the beginning is an intermediate decline where the green line falls below 50. So if you have access to that class, and all of our monthly and our premium subscribers have access to that class, I would check that out. I went through multiple steps on how to determine when that intermediate pullback, or at least the signs that we are going to get an intermediate pullback. And again, when I say an intermediate pullback, I mean an extended period of time with dark pink shading and a red line. So the intermediate line falls below 50 and we stay down for a while. Now, we might not go down this much. 30% in 4 weeks is a little unprecedented, and probably we won't see that again for a while. Hopefully, we won't see that again for a while. But we will go down and we will stay down for a while. Especially considering that we've had a 4-month intermediate run, which is longer than normal. Which means if the inhales are longer than normal, then the exhales will be longer and bigger than normal, and that's where the Fibonacci lines come in here. Again, an inhale down to 3,100, and exhale, down to 3,100, and that's just a 23% retracement, would be pretty significant. Would be the beginnings. And remember, again, I will always say this: we can get from 0 to 23 in a snap of a finger, right? That's all it takes for us to fall down between 0 and 23, and normally the gap's not that big, so it's not that big of a drop, but it is in this case because of how big the rally was. It's always based off of the move that we're drawing the Fibonacci lines on. In this case, the move started here low to high, and as big as that rally is, and you can kind of see it rounding into form here, right? We had this big kind of V bottom, and then it's been grinding ever since. So we'll kind of keep an eye on a pullback, into this area once we do get that catalyst. And then the question will be, once we break the 23%, because we would be significantly below the 30-day moving average. In these cases, we didn't get significantly below. Then this was the last 23% retracement that we had on this bullish run. We only got about I think it was 1.4% below the 30-day moving average there. 1.5 seems to be kind of like the number to watch. Anything more significant than 1.5, then that's the beginnings of an intermediate pullback. Now it might go more than that. It might just stay there. Who knows, right? But that's the beginnings of an intermediate pullback when you fall in that much. And by the time we do get to that point, we will be well below 30-day moving average, and it would be the beginnings of more of a sustained pullback at that point, and not just one of these little near-term declines that produces light pink shading and maybe a yellow line to go along with that, which is actually really bullish. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us here on YouTube. That will notify you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, you liked our video today. And number two, you want us to do another one again on Monday. So it's a quick way to give us feedback. If you like our videos, let us know. And you can do it with one click right now while you're watching. If you don't like our videos, you can also let us know by not clicking on anything. That's how we can kind of get an idea of what people are thinking. Two, comment down below on any questions or comments you have about anything we discuss in the video in the market outlook today. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day, and join our Market Outlook Facebook group that we've created. Alright, if you're watching our video on our blog, you can check out our classes over here on the right, and then our Market Outlook live session. So every day I do the Market Outlook. I do a live video on YouTube where I review all old trade ideas and monitor progress and close any if needed, manage those trades, teach you how to do that, as well as we put on today's trade idea before the market closes. So that's right here. Just click on that little play button. And of course, we invite you here, come down and click on that heart. It opens up a new window. Hit that like button right there. Also, click on the thumbs up. It takes you also to a new window, your Facebook page. Click that like button right there. It's nice to see the numbers getting a little bit higher. So again, that benefits us because the more likes these have, the more likes there and here that these have, you can see over 100 there, then the more Twitter and Facebook will promote our content to all of our followers, even if they're not on when we post these. That benefits you because they will promote content in your timelines from the accounts that you follow and engage with the most. So we try to make it really easy for you to engage with us right here. And again, you can do right while you're watching the video here. All right, now let's take a look at the weekly chart. First, we'll look at this one here on SPX. And again, nice, good bullish Hakinyashi candle. So not even a transition candle. We're not looking for an intermediate pullback anytime soon. I mean, You typically have to see some kind of transition. We did here, and probably should have had an intermediate pullback right here, right, in this June 15th week, and all the way up through pretty much through the second half of June. We probably should have had something here, and that would have been a little bit more healthy, but instead we did, and we continue to rise, and it's been really bullish candles ever since, and all of them. Look at the Dows. I mean, that's about as bullish of a candle as you could possibly get. Look at all the highs it closed above. Remember, the Hakinyashi close is even more significant than the regular close, because it's the open high. It's an average of the open high low and close for the for in this case the Dow Jones for the week. Nasdaq, a little bit of an inside candle here, so reflection of a little bit of a slowdown. That's not surprising. What that does is it sets up for the potential of a transition candle next week, because the midpoint's going to be right around 11,000, and we're trading at 11,164. So that's all it takes is 164 points to get below the open. The Russell, like the Dow, again breaking above that 78% line, and really again most of the breakout occurred early, but you can see we're 2 weeks into a golden cross. The Dow is 4 weeks into a golden cross. Typically, when you get those golden crosses, there's a pretty decent retest, either to the 50 or eventually to the 200 afterwards. So keep that in mind. Watch to see, any kind of inside candle. If we end up getting that next week, like the Nasdaq, then that will set us up for the type of reversal candle that can lead us to more of that weakness that we're expecting. Okay, so that's what it looks like on there. Let's look at the weekly chart for the market forecast. So let me come over here to a 5-year weekly. You notice again very strong bullish posture that the intermediate line just got inside the upper reversal zone. So again, you can get in the upper reversal zone and then stay there for a while. Maybe a light pink shaded and yellow line after a few weeks of declines, which is again really bullish, and with the rally off of that. But yeah, once you get up above 80, now there in 2018 we only had a little of a brief run up there, and that ended up being right before the Q4, coming off the Q1 weakness and the Q4. Remember, we were in a stealth bear market that started here, that really kicked into the gear in the U.S. here with bonds and gold taken off from the fall. International stocks were really declining, and when U.S. stocks took off, international stocks stayed down. So they peaked here, and then everything else peaked over here in September, October of 18. So from that point, from here all the way to the COVID low, we've been in the bear market. We just don't know that or see that because of the strength, and the fangs have really lifted the S&P up to the high side. But you can notice again, when you get above 80 and you're bullish, you can be bullish for a while. And market sentiment's already pretty darn high, so we'll see how long we can get this thing to run. Last time we were coming off in early 2016, the long-term market sentiment was down a little bit lower than where we're at currently. So we'll see how much of a run that we have on the S&P. Of course, the Nasdaq on its weekly weekly chart for the market forecast, you can see the strength. It got a cluster at the beginning of this intermediate run. It's a very good sign, something like this. And it doesn't mean that we won't have weakness. We can have some weakness, but very good sign to get it early on, because it means that we could be above 80 for quite a while on the Nasdaq. So we'll see how that plays out. And again, you can see from from late 2018, the brief Q4 run, and then how quickly we were just back to dark green shading and green line, and so not very much of a bear market at all, thanks to the Nasdaq 100, which is mostly now about 50% those top 5 companies that we all know about. So let's take a look now at the 3 green arrow chart for the S&P. Of course, we have 3 green arrows, and we are still easily above the 8-day moving average. Even with the weakness that we're getting here. The MACD is above its moving average. Stochastics is below it, but still in the upper reversal zone. So, I mean, we're slowing down, but we're not like falling down. We're not. I mean, there's no red flags yet. There's not even really any yellow flags that we're gonna like start this intermediate pullback tomorrow or anytime soon. Probably have to wait until we get through, because of the strong momentum we have. We'll probably have to wait till we get through August expiration before we start to see any kind of weakness. And again, any weakness will seem more significant than it really is, right? Because of the depth of the weakness, if we drop to the 23% line, it will seem like we're really falling off a cliff. But again, you have to put that, that would be falling off the cliff if we're over here. That move would be similar to how we felt, to getting to right here. And at that point, that was falling off a cliff. That was a significant drop. And again, it was in context of the move we had before that. But if we made that same move, this move right here, if we made that same move right now, it would be nothing, because it would be in the context of this big, huge rally. That was well below the 23% line of this intermediate. In fact, if you look at it here, I'll show you. From this low point, when we really started to get bullish all the way up to the high, wherever that ends up being, so right around 33, was it 33? Ugh, it's so annoying that I can't see that. There we go. So right there. So again, you can see how that drop, this where my cursor is, that was a 50% retracement of the intermediate run that we had right there. The same move right now, the same move, if it were to occur like say Monday and Tuesday and Wednesday. So let's say it occurs next week. The exact same move would only be a 23% retracement instead of a 50%. So you can see, again, it's all in context of the move prior to it. Okay. All right, now let's take a look at the intraday chart, and you can see how we're kind of slowing and grinding even as we speak here. A little bit of a drop, at the end of the day before, a final late push to the upside that we're mostly holding. We're down to 336.45 in the after hours. But you can see the weakness, and you can also see too that we still haven't really filled in that gap from Wednesday. That's on the table next week, so just keep an eye on that, as well as this gap over here from a couple of weeks ago, and for that matter, this gap. So, it would be very easy, but especially easy to do this one because it's above the 4-week value area, and for that matter, even this one. So that's a move down like 330, and I said before, if we did get down to 330, that's like to the 17-day moving average. That would not be an intermediate pullback. It wouldn't even. Of course, remember the 23% retracements way down here, right? Below this level here. So that wouldn't even be close to an intermediate pullback. But that's the type of pullback that we can get, as you can see on the intraday chart, simply by filling in gaps, like common gaps, And if you think we can get to 0 to 23 really easily, we can get to this level, to 330, or maybe even a little bit below it, maybe down to 326, 327. We can get down to that very, very easily. In fact, current volatility says we can get down to about 325 within one standard deviation at current volatility levels. And that's at extremely low volatility too, as you'll see here in just a second. Let's take a look at today's range. Let's see, where is it? It would be right here. So let's take a look at today's range and volume. So 1.8 points, volume 47 million. So we're getting just very, very low levels and inching our way towards that 1% mark. The more we get days below 1% of the price of the SPY, which would be about 3.3 points, and we are obviously well below that at 1.8. We still are relatively high on an absolute basis. We are still, the volume though is extremely low, extremely low volume. The 4-week average is just pretty much gone down to nothing. But we don't see the same thing occurring in the VIX. The VIX is also extremely low. In fact, if you look at the VIX here, the VIX rarely closes. In fact, this is the first time the VIX that I can see going back that the VIX has closed below 80%. In this case, twice, 2 weeks in a row, but it's closed a week below 20%, but closed above 20 on an absolute basis. This would be 80% relative to the VIX 3M, the 3-month VIX. That's interesting. I mean, because again, that's extremely low. And then if you look at the monthly chart of the VIX, you notice rarely do we close below 80%, and the times that we do have led to pretty big jumps in volatility over the course of multiple months. Right, in this case it was 3 months, and over here it was multiple months, and then here it was 3 months. Over here it was 4 months. So you get the idea. So it's now, granted, we're only halfway through August. You notice that we get lots of candles below 80%, but we never stay down there. So is that going to be the case again? Considering that we are still below 80, there's a very good chance that would be the case again. So again, does that, when are we going to get the pop in volatility? Is it going to be before August expiration or after? That's been the biggest question. And we've been leaning more towards the after because of how strong this trend is. But you can see why there's a good chance that will happen. Because if we didn't get it, then September might not be very pretty in terms of, a pullback. It might be towards the middle to end, but at some point in time, we've seen, if we close the month below 80%, we've seen what happens in the past. And it's been multiple months. And who knows, maybe that will be the case here, where we close August without any significant movement until we get to Labor Day weekend. And then now September and October and November end up being relatively volatile months because of the presidential election and the uncertainty surrounding whether the incumbent will win or if the challenger will, which the more uncertainty there is in other elections past, that has been an issue. That's been a reason for increased volatility in the markets, because markets just do not like uncertainty. They like to be able to price in, even if they don't like the result, they like to be able to price in expectations and certainty. And so there's probably going to be a lot of that lacking over the next so many months. So to summarize our market outlook, the posture remains strong, will most likely remain strong for another week or 2 or 3 as we head into the end of the month, probably a week or 2. And the ranges and the volumes are going to continue to look like what we've seen, just very, very light volumes. We know what the red flags are to watch for, and we're just not seeing very many of them yet. There might be a few little yellow flags here or there, but nothing significant yet that would suggest the intermediate pullback is looming, is impending. So again, that just means this grinding higher, and there's going to be, the opportunities for upside, directional upside, are going to be few and far between in this type of market. We traded FedEx here recently, and that's had a pretty good directional move. There's been others, but it's just going to be a grind, and that's why buying call options by themselves are so hard to do, because a lot of times stocks just don't move very fast or very quickly, and it makes those call options, it's like watching molasses or paint dry, because at the same time stocks don't move very much and this grind to the upside. Again, I'm talking generally, there's also always individuals stocks that can make big runs, but if we're just kind of grinding to the upside, then that time decay just kind of wastes away. It makes it very difficult unless we can get a good directional pop. And considering the maturity of the intermediate trend right now, any good directional pops from here are going to be limited to very specific stocks and industries and sectors. And that's okay, because at some point in time we'll get an exhale. At some point in time, most everything else will give us we'll pull back towards support, and then we will get a lot better directional opportunities from there, and we'll be paying attention and being ready to pounce on them as they develop. So what do you think? Do you agree with that? Do you disagree? Comment down below, especially if you disagree, as to what you're thinking and why, and what you see that would suggest that either you're a lot more bullish than I am, or that you're a lot more bearish than I am. So if you have a chart or an indicator that's a big red flag, if you see any red flags yourselves, share what those are with our community down below. All right, now let's take a look at what's driving the price action here, and let's look at how things performed this week. So let's go to August, and we'll go to the 10th, and just look at how things developed over the course of the week. U.S. stocks obviously finished the week. The SPY finished the week strong. The Qs are positive. Qs also finished slightly positive. They were flirting with the negative week, especially early on in the week, right? The Nasdaq was down to 2.5% at one point in time, close to 2.5%. But you can see, look at the safety trade unwinding. The safety trade is starting to unwind, and that's the dollar didn't go up. It went up a little early this week, but it was down for the week, slightly down, but down nonetheless. And yet the safety trade, and again, I mentioned this before. When you and I tweeted this out actually for those of you who follow me on Twitter. Let me pull this over so you can see it. I tweeted this out, and I've talked about this before, but here, let me bring up this one. I'm bringing it over here. So this is in the fall of 2018, where I believe that the bear market really kicked in gear. Look at rates this is a 10-year linear regression. Rates were extremely overbought at the time, or whatever, however you would want to say that. They were extremely high. Relatively speaking, right, according to their linear regression trend line for a 10-year period, which is a pretty significant long-term period. And of course, we all know what happened. The Fed raised rates one more time in December, and then everything fell. And again, that's what happens. That's how bear markets start. The Fed raises, the inflation expectations rise, the Fed raises rates, and then they raise rates too much, and then we get a bear market. And then during a bear market, here, you can see what ends up happening is we fall. The interest rates fall. So again, that's why I think that this is kind of a stealth bear market that we had, because it was so significant. It wasn't just a gradual fall. It was a pretty significant fall that we had to an extreme low point. So again, bear markets don't start with the Fed at 0% interest rates and yields, at their all-time lows. Right, the bear markets start when the Fed has been raising interest rates, and we're at extreme high points. Again, relatively speaking, according to their linear regression trend line. And of course, even not only is this all-time lows, but it's also 2 standard deviations down. And you can see the week that we're having this week. So that's a sign that we have a lot more unwind left to go of the safety trade that's been so bullish during this stealth bear market. It's again, you go back to, and really started in that January 26th period of 2018 all the way up to now. And if it wasn't for a 60% run on the Nasdaq, especially even at the lows of COVID, so you go to March, I think it was March 23rd, when I believe that the bear market hit its lowest point. Right, it's October of 08, it's July of 2002 moment. It was right here. In March, at this point, you notice the Qs were not even negative from that early January peak in 2018. Everything else was. EEM was down 40%. EFA was down 37%. Commodities were down sharply. Real estate was down sharply. The S&P was down 20%. Of course, it would have been down more if it wasn't for the Qs. And then, of course, IWM was also down here about it looks like 37%. That's bear market, right? So we didn't think we were in a bear market because of the Qs. But look how bullish. Bonds up 33%, gold's up 15%, the dollar was up 20%. Those are huge, and now those things are starting to unwind, and we've seen the unwind in the dollar. The dollar's been a pretty significant unwinder, and it's just getting going, right? When you look at the long-term move on the euro, we're just getting going here to the upside, especially when you look at it on even longer term than that. If you go to like a monthly chart here, we are just getting started, right? It might have to go back a little bit further. Just getting started on this bullish run. The PPO is just about to turn positive here. So, we are just breaking through this downward trend line. It's, we've got good monthly candles here going into August. This trend is just getting going on the dollar's unwind. But then you look at bond yields, and they're also just getting started themselves. In fact, this is the most bullish week we've had in a long time. And that's not really even technically a bullish Hakinyashi candle, but we've got lower lows with higher lows on the PPO. That's setting up for a divergence to come in, and you notice on the regular candle we have broken the 50-day moving average. Now last time it didn't hold, but if it holds, you would expect to fill in that gap up to the 200-day moving average, which would be a significant move to the upside. I mean, that's about as bullish of a week that we've had in yields for a very, very long time. And then, of course, gold's not going to unwind too sharply, but you can see the move that it had this week. You don't expect gold to like drop sharply, just expect it to underperform. It's been an outperformer during this bear market that ended again with the COVID, but it's been an underperformer. It's been an outperformer since. So expect to start to underperform. It's going to be hard for it to really go down too much, with the dollar also going down, because those two are kind of an either-or trade, right? Physical currency or paper currency. But just expect stocks, especially international stocks, which are also starting to work their way to the upside with the recent golden cross there on EEM, and you can see it's Hakinyashi. It's really just getting going too, especially when you look at it on the long-term basis here, what the chart looks like. With a weak dollar, there's a lot of opportunity in these international areas that are really beaten up. I've shown you this chart in the past. This is EEM relative to SPY, and let's go out on a weekly chart. So that means I need to change some of these patterns here. Let me get this to an exponential moving average as well, and then put this at a 1040 and 9. Yeah, everything else looks good. Okay, so we've talked about this before. It hasn't been above 60, and we had a brief little period here, but for the most part, in brief little period there, it's been on a significant downward decline for years, right? Go back all the way 20 years. Look at that decline. So there's a lot of opportunity in international stocks to be really bullish with any kind of weakness in the dollar. At the peak here, it was 3 times as large. The ratio was 3 times as large as it is now. So that's how much opportunity there is to the upside. In fact, the PPO hasn't even turned positive yet. Lots of opportunity for international stocks over the next little bit as the safety trade unwinds. All right, now let's take a look at the sector performance and how they performed here this week. So let me pull up the sectors here and just take a look again at just this week, right? Where it seems like the safety trade had a little bit of an unwind. I need some gold and long-term bonds. Well, look at that. Utilities and real estate also down pretty significantly. They were pretty significant outliers to the downside. And to the upside, it wasn't your typical XLK, XLC. They weren't the bigger. XLY stayed strong, but it was industrials, energy, materials. It was anti-dollar sectors. Financials lagging a little bit because yields are, but they lagged. They did outperform the broader market with those rising yields, and they had a really strong start to the week. Again, these energy, industrials, and financials, those are the beaten up areas, the value type areas, and that a lot of people are anticipating rotation, like that they'll take over the leadership. And they could very well take over some leadership and outperform, but don't expect such a wide gap of performance. If we're going to maintain bullishness, which is what the safe haven areas are telling us, then don't expect XLK and XLC to underperform the market for too long, right? They might not outperform everybody, but they'll be up here underneath, close. So any kind of outperformance we get, it won't be nearly as big as what the Q's of outperformance has been up to this point over areas like financials and industrials that are so prevalent in the Russell 2000. All right, so that brings us to our trade idea of the day, and it's actually in this material sector, and that is, let's take a look at Nucor. Nucor had an interesting little pattern here on its market forecast. As its intermediate posture turned strongly bullish, it popped up and is showing an overbought cluster here, which is very good to see at the beginning of intermediate runs. That means it has a potential for a longer intermediate run. Then we had a little bit of weakness, and then popping back up today, giving us really good bullish signals across all these different oscillators. The above 60 on the RSI, we're above 100. We've hit the negative. We hit the 200 mark there. You look at the DMI, and you can see a good a good signal there, above 30 on the positive index. The ADX about to cross above 25. If you look at its Ichimoku cloud trend strength indicator, you can see that we're not quite above 5 and above 80, but we're getting really close. It's got a nice good run. We're breaking downward trend lines. We're getting up above the Ichimoku cloud, easily above the green line. So very strong patterns all across the board on all these charts, rising above the rising 8-day moving average. Very strong momentum from that regard. The long-term chart here, you can see breaking the 200-day moving average with strong rising momentum. So a good chance to finally break through with the golden cross and potentially keep it going forward. So as I mentioned earlier, when we're looking for directional opportunities, we have to be a little picky and choosy about what areas in the market, and material seems to be one of those areas, and we see an opportunity here. Maybe not for a big time move to the upside, but if I were to buy the 47.5 call for September, which is right at the 40 delta, so a little bit out of the money, but then sell the 50 call to help offset the cost of it. Brings my cost, looks like we got in for about 75 cents here, was what our cost ended up being, up a little bit since we got in during the live session. And now we need to get up to 50, and if we do, we've got about 3/4 of a normal risk here, because we don't have to worry about earnings, and it's got a pretty decent bullish trend. It's going to be pretty obvious if it turns around. So we'll probably be able to get out of half of that. Probably say, what, 375? It's going to be very easy to get out of half of that risk. On the flip side, for $375 a risk to get almost $1,800 a reward, we'll take it, right? We'll take that, and better than 2-to-1 when you are looking at better than 2-to-1 risk reward when you're looking at worst case scenario, which will be very easy to avoid the worst case scenario if things do turn around on this stock. So again, it's a directional trade. It's a low probability trade, but it gives us good reward for the risk that we're taking on a stock that doesn't have to go up very much. It only has to get up to 50 and then stay above 50, which you can see obviously was inside of 1 standard deviation. But there is a volume node in this area. It doesn't have to break out. It just has to get up to this node and then stay there. And it's got a nice little steady trend that has been developing. It seems that we're working into a nice steady trend, especially with the weakness in the dollar and the weakness in the unwinding of the safety trade going forward in this particular area. So if we're going to get some continued moves higher in equities, looks like it's going to be these types of stocks that give us those continued moves higher, like it did at the end of that June 8th run that we had. Alright, so that does it for today. You've heard from me, now I want to hear from you. Use that link popping out in the top right corner of your screen, and let me know. Open up any new threads with any questions or comments you have. Let me know what you're thinking. Reply to anybody else's threads that they've opened up, and let's keep this conversation going over the weekend before our next video as to what's going on in the market and what you're thinking there. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon on YouTube, as well as on Twitter and Facebook as well. And comment on our video on YouTube, as well as in our Market Outlook forums. Again, thank you very much for watching. Have a great rest of your weekend, everybody, and we'll see you all next time.